Welcome back. You're watching Big Deal, and we have with us Ashley and Srini talking about the IVCA's plans going forward. Now, Srini, there are various aspects that we have discussed, but let me address the big burning question. Is the regulatory environment for the AIFs challenging in India?
No, I don't think it's challenging in India, but the regulations have evolved over time. We started off as a light touch regulatory regime, and over time, obviously, experience teaches us what needs to go right and what needs to go wrong, and regulations are born out of those experiences. And in the recent past, there have been a number of issues on which regulators have not been happy in terms of the way AIFs have conducted themselves, and therefore new regulations have come about. Having said that, I think it's a constructive process. We are engaged with the regulator to make sure that while we want to make sure that we follow a governance path, we have already committed to the regulator that by the end of this month we will have our code of conduct, and we will streamline all the processes and issues that investors may have faced in the past. And that's something that we are very constructively engaged with the regulator. And to my mind, I think our interactions believe that the regulator wants to make sure there's a clean market, and they're very interested in developing the market. So I think it's a very constructive dialogue, and we should be able to move forward to actually make a very robust alternative investment industry, which can give birth to multiple strategies. As we have seen, there are credit funds operating in India, real estate funds operating in India, venture debt funds operating in India, and all of these are interesting themes to follow going forward.
All right, so various suggestions and representations have been made by the industry to the regulatory bodies with this regard. Now, Ashley, when we talk about the level playing field between the Indian domestic investors as well as the global players, where do we stand on that front?
So I think, there have been some questions around, mainly from the tax side, where I think foreign investors have a little bit of an edge relative to domestic investors. And that's a conversation that, again, we've been having with the Ministry of Finance around, how do you ensure that there is no difference in taxation levels, primarily around on account of capital gains. Because it is ultimately similar pools of capital. I think there are obviously certain advantages and disadvantages for both, in terms of sectoral limits, etc. I think, if you're an India fund, there are some advantages that you have relative to foreign funds. Obviously, the point that Srini was making is core. Right? How do you ensure that as a regulator, I think it's important for all of us to have pools of capital, both from an investor side as well as the manager sitting in India. So how do you have a constructive set of regulations that encourages even foreign investors to come in through the AIF route? Globally, if you look at other geographies, even if funds may be based outside the country, they typically are encouraged or have benefits to come in and register as a domestic fund, and that should be the core. That how do we encourage those fund managers to set up structures that are based in India as opposed to being outside India? Because the rub-off effect for that is quite large, right? There's a whole bunch of ancillary benefits from having the manager sit in India and be regulated in India versus being outside. So I think that is that should be the focal point, in terms of how do we bridge the gap there. So and if you have a regime where India funds are potentially taxed at a higher level relative to foreign funds, that does not help that cause.
Right. So you raised a very important point, and I'll throw that question up for Srini. Cost of raising money. You want to address that, Srini?
Yeah, I just add to what Ashley said, and I'll also answer the question on cost of raising capital. We have the Atmanirbhar Bharat as an objective for us. Make in India as another objective for us. And I think to Ashley's point, what we as an industry would like to see is also manage from India, similar to Make in India. So you get capital from wherever you do, globally or otherwise, but the environment must facilitate more managers to come and manage the capital from India, because then the ecosystem benefits of all kinds of global practices comes into the picture. With regard to cost of raising capital, right now the distribution channels through which private capital is raised in India is reasonably consolidated and therefore expensive as well. And so if you were to compare it, for example, in mutual funds, currently those costs are regulated in mutual funds. There is a very broad regulation right now, but overall the cost of raising capital from the domestic market is quite high compared to some of the other markets. Over time, I'm sure that will change as competition comes in.
Right. So that's one area that needs to be addressed quite effectively. But Ashley, I can't let you go without, giving me a trend on where PE is headed at this particular point. What are the trends really picking up? You spoke about the buyout transactions, but what I also gather is that the promoter class, from confidence money to buyout, it has been a long journey. But with the valuations picking up, whether the promoters would like now to exit completely or ride with the private equity player for a later exit at a higher valuation is also one question that I throw to the PE community right now. So what are the trends that you're seeing, and what are the sectors that are really becoming the flavor of the season now?
Yeah, so just addressing your first point, I think we have seen a couple of changes that are occurring, which is leading to people moving more towards house, right? One is entrepreneurs have recognized that private equity funds do not bring only capital to the table. There is value that they bring to the table as well. And so they're seeing that and they're enjoying the benefits. Most PE firms today have a team that works on the operating side. And so we have operating folks who help create that benefit, and entrepreneurs are enjoying that benefit as well. And then the second point is, previously, entrepreneurs would not want to divest their businesses because of the next generation. We're seeing the second generation in promoter families wanting to expand and do other things. And so that has given a lot more confidence to entrepreneurs to say, look, maybe we want to sell out the business. I think one good structure of managing the bridge between the expectations of the entrepreneur in terms of their valuation versus what PE investors want to pay is to allow them to roll over a portion, and whilst the PE investor takes control, as opposed to buying 100%, maybe you buy 80% and let the entrepreneur continue to own the balance 20%. We have seen that balance 20% of the entrepreneur is far more valuable than the 80% that they've sold because of the value that the fund has added in the next 5 years.
Yes.
And so entrepreneurs are encouraged and like that, where they feel that they have not left money on the table and get the benefit from that.
Right. Yes, and okay, so that's a very interesting point you made, where a lot of private equity may not want to have the promoters part of the company once they have bought control. But finally and very quickly, key trends picking up in private equity investment in the country.
No, so I think the kind of sectors that we've been looking at are continuing to remain interesting. So I think financial services has always been interesting. On the pharma healthcare side, I think we're seeing a lot of opportunities. The India macro offers a big story from a consumption perspective. So anything that's domestic consumption, whether it's a consumer business or it is the new age digital businesses, I think are definitely very, very interesting. AI is definitely an opportunity. One may I know there are some conversations around, is AI going to threaten the overall business services business, given that it could sort of replicate what is being done. But there are contrarian reports as well saying that what is needed at the back to create the back end of the AI, and is that an opportunity for companies to be able to help create that, similar to the Y2K kind of situation many years ago.
Right.
So those are interesting opportunities that we are definitely seeing.
All right. Thank you so much, Ashley, Srini, for sharing your thoughts on investing ecosystem in the country and what lies ahead when it comes to IVCA's agenda. Thank you so much for joining us, and thanks to all our viewers for tuning in. Keep it with CNBC TV 18.